The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome everyone to our webinar on changes you can expect as a business owner after closing a private equity deal presented by Hadley Capital. My name is Megan. I'm the senior editor for Divestopedia.com, and we're your online resource for mergers and acquisitions, valuation, value creation, and other divestiture topics. I'm joined today by my co-host, who is also the co-founder of Divestopedia.com, Mr. John Carvalho. Now I'll let John introduce our guest presenter. John?
Thank you, Megan, and thanks to all our guests joining us today. We have a really great topic for our webinar today. We're going to explore common changes that will occur in a business after closing a transaction with a private equity group. We're going to be covering a number of areas on this topic with our guest, and in the last 15 minutes of the webinar, we will be answering questions from our audience, so please feel free to submit those questions that you might have as we go along. I'm joined today by Paul Wormley, who is the partner at Hadley Capital, and he will be sharing with us his experiences on the changes that occur in a business after private equity investment. Paul joined Hadley Capital in 2005. He has spent his entire career working with small and emerging companies. Paul grew up in a family business environment and is an owner of his own family's community newspaper group. Paul is a graduate of the University of Colorado at Boulder and received an MBA from the Kellogg School of Management at Northwestern University. Hey, Paul, welcome to our webinar today.
Good morning, John. Thanks for hosting.
Before we move ahead with the topic, why don't you tell us a little bit about Hadley Capital and your guys' investment philosophy?
Sure, be happy to. Hadley Capital was founded in 1998 to focus exclusively on acquiring small companies, and we define a small company as a business that has roughly $5 million to $30 million in revenue. Over the past 18 or so years, we've acquired approximately 20 companies across a wide variety of industries, from manufacturing to business services and distribution. The common theme among those businesses is that when we acquired them, they were small businesses. And our approach after acquiring a business is to allow the managers that we partner with in these businesses to do what they do well, which is to manage the business. We provide active strategic support at the board level, and our goal is to add incremental value over a long period of time. Our average hold of our companies is in excess of 7 years, which is somewhat unusual in the private equity industry. And we try to hit a lot of singles and doubles over a long period of time. We found that that approach leads to significant growth of our businesses, again, over a long period of time. My partners and I are currently investing out of our third committed capital fund. We closed that fund in January of this year. That fund has made one acquisition of a company in California and has plenty of additional capital available for investment. One unique aspect of Hadley Capital is that my partners and I represent about 20% of our firm's capital. So when we're buying companies, we're writing checks out of our own checkbooks. And we find that for the average business owner, this is something that they appreciate, that our interests are well aligned with those of our investors and with them and their employees on a go-forward basis.
Well, that's a great overview of the firm. Thanks for that. And it sounds like you have a wealth of experience on the topic today, so let's get right into it. So Paul, tell us, and I think that this, getting into the specifics of what happens after private equity investment is a fascinating topic, because there's lots of content, a lot of discussions around, how to find private equity, how to work through a transaction with a potential private equity group. But not a lot of people are talking about what happens after the actual investment occurs. So why don't you give us a little bit of an overview of what happens in the first 100 days after closing, or what a lot of people call the 100-day plan?
Sure. So Hadley Capital buys businesses with really successful operating histories, businesses that we feel really good about the people involved, the company's strategy, and its ability to continue to do what it's done in the future. And so our goal at acquisition is first not to mess that up. Our stated motto is first do no harm. And so this approach can be a little different than other private equity firms that may come at the business with this 100-day plan concept. In our experience, 100-day plans require a pretty significant amount of change in a short period of time. And while this approach is different from ours, it certainly works. It's just important that business owners understand what to expect after closing. And really, any transaction involves change. It's just important to have some idea or expectation for what that change may be.
Yeah, no, great overview, and you're right. I mean, the 100-day plan, I think, is a lot of people talk about it, but I love your concept of first do no harm, which I think will give a lot of the business owners on the webinar today some comfort that it's not going to be, the business isn't going to be totally turned upside down within that first 100 days.
Exactly.
Great. Well, let's move on to another area that I'm sure a lot of business owners have question on in terms of the potential change within their business, and that's on the operations side. So, after you make an investment in a business, give us your experience on what actually changes in the operations of that business.
Sure. So, when we work with business owners, typically the change they're most concerned about is what's going to happen to their employees. And this is for good reason. Many of the business owners that we buy companies from view their employees as members of their family, and they want to make sure that those folks are looked after in the sale process. And so our goal in any transaction is to try to minimize the impact on employees, such that a seller can tell their employees, look, the only thing that's going to change is the name at the top of your paycheck. And we work really hard to make that a reality. In nearly all cases, salary and benefits remain the same. Certainly the location of the company remains the same. Reporting relationships remain the same, et cetera. Over time, there are inevitably changes that impact employees, but typically these are driven by the management teams running the businesses, and they're made for good business reasons rather than as a result of the transaction. There are more direct changes that take place, for example, in banking relationships. In every case, when we buy a business, we're borrowing a portion of the purchase price from a bank to help us finance the transaction. The bank lends us the money required. The bank that lends us the money requires that the company's primary deposit relationship exist with that bank. So in all cases, the companies we acquire change their banking relationship to the bank that we bring to the target business. So there are changes associated with a new banking relationship, obviously. New checks, new ACH payment and wire instructions, potentially new remote capture or check scanning machines. In some cases, credit cards need to be changed. In cases where we need a local bank relationship for our employees to cash paychecks, our banks will allow us to create a separate local banking relationship for payroll purposes. One of the really good changes that comes from a new banking relationship and working with a private equity firm like Hadley Capital is that we can complete transactions and get loans from banks without providing personal guarantees or really any guarantees to our lenders. And for many business owners, that's a significant change from their existing banking relationships. The last operational change that's probably most meaningful for business owners is that when we buy a business, the team that's running the business continues to manage the business from a day-to-day perspective, as I said earlier. But we do add a board of directors that provides strategic support to the management team. And this is typically new for most of the businesses that we buy. The president of the business reports to the board, and the board customarily meets 4 times a year and is composed of a Hadley Capital partner or 2, the president of the company, and usually 1 outside board member. And we find that our management teams really appreciate the opportunity to have a check-in, once a quarter or so against the goals that we've set for the business and for them. And it's not an extremely formal process when we meet, but we do find it's an important part of how we govern our businesses and how we work with our management teams to maintain the accountability that we need to achieve our goals on a year-to-year basis. So those are just a few of the probably the most significant operational changes that a business owner might face in a private equity transaction.
I'd imagine that a lot of these changes, I mean, you've been through a lot of these transitions and transactions before, so I'd imagine that a lot of these changes can begin being implemented even before the transaction closes. Is that right, Paul?
Absolutely. So the due diligence process, we will identify the processes that need to take place to make these changes as smooth as possible, particularly as it relates to employees, and even with the banking relationships. The lenders that we work with are, their primary customers are small and middle market businesses. They understand the constraints facing middle market and small businesses and are prepared to provide the support that's required to make sure that the transition to a new bank, for example, is seamless.
Okay, and then you mentioned composition of the board. I imagine that too is probably determined prior to closing the transaction. You would know who is going to be on the board before the deal even crosses the finish line. Then.
Good point, John. Actually, prior to even entering into a letter of intent to buy a business, we usually have some idea of the composition of the board after acquisition. In many cases, the business owner that's selling us a business remains involved in some facet. And if they were, for example, to retain an ownership stake, typically that means they'd also be involved at the board level. Or if the ownership group is selling out completely and we're partnering with a new president that may be in the business currently, that person would serve on the board alongside us.
Great. And another thing that you mentioned that I might want to touch on, because I've seen the importance of it on transactions that I've worked on, is just the idea of a business owner not having to have any personal guarantees when they enter into a relationship or a partnership with a private equity firm. I don't think that at the onset when a business owner is thinking about finding a private equity firm, that might not be a big consideration or even something that they really understand or know about. But as the transaction progresses and they recognize that, hey, I don't have to have personal guarantees, that is one of the greatest benefit, I guess, from that partnership and relationship. You want to just touch on that again, Paul?
Sure. I think it's something that really helps a business owner sleep at night. They realize that if they're going to sell the company or a significant portion of their company, that they're going to receive proceeds and that they're no longer on the hook for the loans that are outstanding to the business. That if things were to really go south or really go sour, that the bank's only ability is to come back to the business and it stops there. They can't come back to any owner, the former owner or us, and seek our personal assets, our homes, etc. And I think that's a real comfort blanket for a small business owner who maybe for 20 or 30 years has had those guarantees outstanding.
No, that's a great insight, Paul, and great summary of the changes in operations. I've seen that a few people have just joined on the webinar here, so I'll just let them know that Paul Wormley is hosting and is the guest on the webinar today. He's a partner at Hadley Capital, and he's talking to us about changes that occur in a business after a transaction with a private equity group. So we've just finished talking about changes in operation. Paul, let's move on and give us your experiences on the changes in the corporate structure or the new co that's formed after a private equity investment.
Sure. So the vast majority of businesses and small companies in America are S corporations or LLCs, and so they are flow-through entities from a tax perspective, and therefore the seller of the business is typically neutral in an asset versus a stock sale. And there are a variety of benefits to a buyer for completing an asset transaction, and as a result, more than 75% of the transactions that Hadley Capital completes are asset transactions. And many of the changes that we're going to discuss here are the result of completing an asset transaction versus a stock transaction. Some of the changes that we're going to talk about, contract assignments as an example, may be eliminated in a stock transaction, but if you were to look at transactions in the small company marketplace in totality, the vast majority are going to be asset transactions, and so most of these changes are applicable. The first thing to talk about is when we buy the assets of a target company, we form a new company to acquire those assets. That new company is typically a C corporation, and we can call it, for for our purposes today, we'll call it NewCo. NewCo buys the assets and businesses of the target, and as a result, it receives a new EIN for tax purposes. It's a brand new operating entity, so it has a new legal name. Although in most cases, we will form the legal name to be something similar to the target company's name. So if the target company was, for example, ABC Distribution Inc., NewCo would be named ABC Distribution Holdings Inc. or something similar. From an operating perspective, one of the assets that NewCo would acquire would be the old company's name, so that from an outward-facing perspective to the market, there isn't any perceived changes. The change from an S to a C Corp does involve some tax changes. As we talked about earlier, flow-through corporations typically distribute money to their shareholders so that the individual shareholder can pay their taxes on their individual return. As a C corporation, the entity pays the tax, not the shareholders. So as such, any distributions that were taking place for taxes in the C Corp go away. Similarly, if there were profit distributions in the flow-through S, those would go away in the C Corp for two reasons. One, there's double taxation associated with taking dividends out of a C corporation, which is obviously highly tax inefficient. And second, the excess cash or profits that are generated by NewCo typically are used to pay off debt that was used to acquire the business or to invest in growth opportunities available to NewCo. One of the other significant changes that's derived from forming a NewCo is that any contracts that existed at the target company, for example, with customers, suppliers, vendors, partners, etc., will need to be assigned to NewCo simultaneous to closing. And this can be a pretty cumbersome process, particularly for a company that has a large number of supplier or customer contracts. We acquired a business a year ago that had more than 100 individual customer contracts in place, and all of those contracts had to be assigned to NewCo so that it could execute the contracts at closing. That was a process that took the target company close to a month in order to make sure all those things were in place and ready to go, and something that we worked closely with them to make happen. Obviously, contract assignments from customers is something that can be a bit of a sticky topic for business owners. Many business owners have concern about going to their customers and making them aware that there's potentially a sale pending. And so this is something that we work very closely with the target customer or the target companies to determine, number one, what's the appropriate point in time to go approach these customers about the assignments? And then what are we going to ask them for when we go do it? So that we can make that process as seamless as possible, disrupt that customer relationship as little as possible, and ultimately end up with those assignments at closing. If the transaction were to fall apart very late in the process, this is something that happens extremely rarely, but it does happen. If it were to fall apart late in the process, the assignments that we sought would not take effect. And so sometimes the business owner says, well, I don't want to go do this prior to closing, because if the deal falls apart, I've got all these assignments for my customers and I don't have them anymore. And what happens is that the assignments are contingent upon the transaction actually closing. There are other assignments that can be tricky in getting. For example, landlord assignment of a contract can be sometimes a challenge. Landlords tend to want to drag their feet. They don't have a lot of incentive to want to participate or cooperate, and so sometimes those can be areas that are take a little time to resolve. And also there are some assignments that are less meaningful to the overall operations of the business, and that sometimes we can just simply close around. For example, contracts for a copier or fax machine or something like that.
So Paul, with these assignments, do you find that, a couple questions here, do you find that, how often or how rare is it that the assignments does not get transferred? And then a follow-up question to that, does this give the opportunity for you know, the customer or the supplier or the landlord the opportunity to renegotiate those contracts? Maybe comment on those 2 points.
Sure. Many times the contracts that we're seeking assignment for have specific assignment language in them. And so the process of getting an assignment is somewhat formal and defined by the contract terms. So in those cases, there's not any challenge in getting the assignments done. It just simply takes some time and makes sure that all of the contracts that are outstanding have been identified. In some cases, companies that we acquire have to spend a fair amount of time just making sure that they have robust record keeping around all of their contracts as a starting point. But rarely do we have a problem where we can't get a contract assigned. Mm-hmm. Particularly a meaningful contract that would be significant to the operations of the business on a go-forward basis. We closed a transaction about 3 months ago, and the company had a supplier that represented over 70% of their revenue. And we identified that very early in the process. We talked to the business owner about the need to make sure that we could either get the existing contractor signed or enter into a new contract with the supplier. And as is the case in many of these situations, the company that we were acquiring was a meaningful customer for its supplier. And so its supplier wanted to continue to do business with the target company and was very cooperative in saying, look, we're happy to enter an assignment. We're happy to enter into a new contract under the same terms with NewCo, whatever is most convenient.
No, that's, you know, I often see that, like you had mentioned, as kind of a sticky situation that business owners want to, you know, be very cautious and you know, very careful about the relationships with their customers, suppliers, landlords, etc. So, you know, the fact that you have, you know, done this for multiple transactions and understand that, you know, I'm sure will give a lot of the business owners on the webinar today comfort around the necessity to sign and transfer those relationships.
Yeah, and you know, part of our first do no harm strategy begins before we even own the business. Right? We don't want to do damage to the business even prior to closing by not making sure that we're doing these assignments the right way in the due diligence process.
Yeah, great point. So just a reminder to our audience that we will be taking questions at the end. So if you have questions for Paul, be sure to enter them in the GoToWebinar window pane here, and then we'll be able to answer your questions. So as one of the topics comes up and something comes to mind, please enter in that question, and we'll address it in the last 15 minutes of the webinar here. So Paul, give us your take on changes that happen in a business around financial reporting. And you know, from all of your experiences, all of your transactions that you've done, what's different from a pre-private equity world to a post-private equity world in this area?
Sure. The primary reason that there are changes in financial reporting is that the businesses that we're acquiring, and most small companies, produce financial statements for internal purposes only. If the target business is closely held, in other words, it has 2 or 3 primary shareholders, the financial statements of the business are used typically by those owners, and in many cases those owners are also managers of the business, for their internal purposes. And what changes in a private equity transaction is that now there are external users of the financial statements. Hadley Capital would be a user, although we are an owner, and our lending partners, for example, would be an external user of the financial statements. And so all the companies we acquire are producing monthly financial statements, an income statement, a balance sheet, a statement of cash flow, and under our ownership, they continue to do that. We do put some probably more stringent time frames around the production of financial statements. We tend to like to have them produced at least 2 weeks after the end of the month. And a more significant change may be that all of our companies produce their financial statements according to GAAP, which are generally accepted accounting principles. Many of the businesses that we buy are not producing their financial statements in all cases according to GAAP, although this transition to GAAP reporting for the companies that we buy tends to be a fairly low hurdle for them to clear on a go-forward basis. A more significant change from a financial reporting perspective would be that all of our portfolio companies are audited by independent third-party accounting firms. We've never acquired a business that was audited prior to our ownership. And so this is an area where we need to work with our companies after acquisition to make sure that in the first year of our ownership, they're prepared to survive, if you will, a third-party audit. And we've never had a scenario where our companies were not prepared and did not thrive in the audit. But it is a fairly material change. It also is an additional expense for a small business, and typically an audit we find by a competent third-party firm is approximately $25,000 to $30,000 a year. The other change from a financial reporting perspective is around budgeting. Most of the companies that we acquired don't have budgets prior to our acquisition. Many of them perform what we would call an annual forecast, where they might say, last year we were 14 in revenue, this year we'd like to be 15, and last year we made $1.5 million, and this year we'd like to make $1.6 million. But that would be the extent of their budgeting process. All of our companies go through a formal budgeting process each year. The outcome of that is a monthly budget with revenue expense forecast, capital expenditure plans, investment plans, etc. In the first year of ownership, those budgets are pretty basic, and then we build on the budgets on it. Each year we get better and better and more refined, and the budgets are also integrated then with the company's overall strategic plans, such that significant strategic items that require funding, for example, are included in our budget plans. The strategic plans may also include revenue or growth plans based on a per customer or per product look that would then be incorporated into the revenue budget. And much like the board of directors, we find that our teams find that the budgeting process is really helpful in helping them improve how they run the business, provide additional visibility into how they're making money, where they're making money, why they're making money. And in the end, it's a process that I think is really valuable.
That's great. A quick question around the audit and just the external service providers. Did you maintain the relationships that the business has with the existing service providers, or do you will you change the accountant or the auditor and find somebody that's a different third-party kind of service provider around those preparation of the financial reporting?
In accounting services specifically, many of the firms that we acquire are using a third-party accounting firm for a compilation or review of their existing financial statements on and most typically on an annual basis. The firms that are providing those services in many cases do not provide audit services. And so we would introduce the target company to a new audit firm, but we don't require that they use one specific firm that we may have a relationship with. If there is a local audit firm that they feel would provide a high quality of service to the business at a fair price, we're happy to use an existing relationship that they may have from an audit perspective.
Great. No, that provides a fantastic overview of the financial reporting, and I also find that middle market businesses could be a little bit more detailed on the budgeting process. So the fact that you bring that rigor and that new discipline to a business, I'm sure pays dividends on the ability to grow and the ability to just take the business to another level. Do you find that, Paul?
Sure. I think that there are a variety of disciplines that when enacted provide positive benefits to our businesses, and this is not sophisticated theory and rocket science. It's just embracing common sense, doing things with a level of discipline and persistence that, many of the businesses that we buy are already doing these things. And so what we find is that we're tweaking some existing practices, adding, maybe a handful of new things, but that the ability levels and the competencies of the existing teams are such that they adapt really positively to these changes.
No, I agree with you 100% there. So Paul, again, you have a wealth of knowledge and experience on, working with mid-market, businesses, helping them with these transitions. So what is your advice for the business owners on our webinar today when they're thinking about, getting private equity investment and picking the right private equity partner for their companies and to move forward with?
Sure. I guess I'd back up and say that, the sale of a small company involves change regardless of the type of buyer. What we've outlined here are some changes that might be specific to a private equity firm or not, if you were to partner with a private equity firm or not. Our advice to the business owners that we are talking to about buying their business is to people that we've worked with. Call the presidents of our businesses, call business owners that we've bought businesses from. Validate that what we're telling you about the way we act and the things that we do is true. We feel like over the last 18 years, we've built up a pretty good track record and a reputation that we're proud of. And I would say, if you're working with somebody that isn't willing or able to provide you with that kind of reference point, maybe you should consider an alternative.
That's great advice, and I would agree 100% again with that. Just confirming and getting some references and seeing how the relationship has worked for other for other companies is a great place to start. So now we'll move on to questions from our audience, and I see that a few have come in. Megan, do we have some questions from our audience that we can ask Paul and get him to share his experiences on?
Absolutely. Let's see here. I see one question we'll start off with. Paul, can you tell us more about the banks you work with?
Sure. So we work with a handful of large banks whose primary business is working with small and middle market businesses, as I said. So these are not money center banks. It's not Chase or Wells Fargo or Bank of America. These are large, branded, in most cases, public companies who have a level of sophistication in working with private equity firms like ourselves and experience lending into a private equity-backed transaction.
Okay, great. Thank you for that information. I'm just looking for next question here. Can you describe the process from the point of signing the letter of intent up to closing?
Sure, good question. We divide the process from letter of intent to closing into 3 stages, and each takes about 30 days. So it's a 90-day process from letter of intent until closing. And the first 30 days is spent doing due diligence on the target company. The next 30 days is spent identifying lenders for the transaction. And the final 30 days is spent doing the legal work required to get the transaction closed. And the process is broken into these 3 stages somewhat intentionally. We want to do the due diligence first to make sure that we fully understand what we're buying and all of the incumbent risks. Once we've done that work, and that's a robust 30 days, we are in a position where we can, with confidence, go to our lending partners and ask them to support us in the transaction and provide us with the financing required to get the transaction done, and also importantly for them to rely on the due diligence work that we've done so that we can speed their process along. And then we enter the legal phase after we have done all of our work we have financing for the transaction, and we simply need to paper the transaction according to the terms of the letter of intent. We have found that if any of these processes are run at the same time, it's a lot of work, number one, and things tend to drag on, particularly the legal aspect of it tends to drag on, and it becomes somewhat inefficient and costly.
Great. Okay, thanks so much for that. Let's see. Next here, can you describe how the day-to-day decisions will be handled after closing?
Sure, I talked a little bit about it in my comments, but we're buying businesses with really great management teams, and those teams continue to run the business from a day-to-day perspective after closing. The partners at Hadley Capital do not get business cards. We don't get an office in the target company. We provide a sounding board to the teams, the professional management teams that are running the business, and that can be on things that there may be a particular something as small as a particular employment issue that the president or one of the managers wants to talk about, or something very strategic like pursuing a potential acquisition. But we provide that support as very active board members and owners. But we don't get involved in the day-to-day running of the business.
Okay, great. Thanks so much for that too. And our next question seems to be focused around tax implications for owners immediately following the close of a deal. And the question is, how do you make sellers indifferent between an asset deal versus a stock deal?
Well, as I said earlier, if the target business is an S corporation or an LLC, a flow-through entity, typically, if business owners were to talk to their existing tax advisors, I think what they would find is that they're neutral from a tax perspective in doing a stock sale versus an asset sale. And obviously, every situation is unique, but we've across the 20 or so transactions that we've done, we found that to be true. And so, obviously, I'm not a tax accountant or in a position to give tax advice, but typically what we find is that for those flow-through entities, business owners tend to be neutral as to whether they do a stock or an asset transaction.
Okay.
And Paul, sorry, before we move on to the next question, do you work with and I'm sure you do, but do you work with the businesses to find, tax effective solutions and planning before the deal is actually closed?
Yeah, absolutely. We strive to follow the tax rules as they're written, but we don't want to pay more taxes than we have to, and so we always are looking for the most efficient way to complete a transaction. And from time to time, there are certain strategies that are deployed to make that to make the transaction potentially more tax efficient for the seller. And so long as there's no negative implication to NewCo, we absolutely want to pursue those strategies. There's no reason to pay more taxes than anyone is required to pay.
Okay, great. Thank you. This next question is about the assignments. Why is it needed to reassign all contracts to NewCo? And the guest writes, I thought NewCo was just like a holding corporation, so I suppose the contracts can still be linked to the operational company, ABC Distribution was the example you were using. Could you talk about that, please?
Sure. If NewCo were a holding company that was acquiring the stock of the target business, the requirement for those assignments may go away. Sometimes contracts would have a change of control notice, which is separate from seeking an assignment of the contract. But in an asset transaction where you're actually forming a new company, that new company needs to have a contract with all of the target company's existing customers. And so it would be as if the customer were entering into a contract with an entirely new business. The reality is that when the managers of the business go to seek the assignments, they say, look, yes, it's a new company, but it's the same team, same service, same price, same offering, same. And in most cases, because the the target company is providing great value to their customers, the customers are happy to enter into those assignments. And so, it sounds like the question is derived from, if NewCo were a holding company, why do you need an assignment? Well, if NewCo were a holding company acquiring stock, you wouldn't need an assignment in most cases.
Okay, thanks for that. Now, our next guest is asking, if a target company owner is not currently working with an M&A advisor or broker, does this change how you work with them, and do you suggest that they are represented?
So we work with many small business owners who are not represented by an M&A advisor. The business that I referenced earlier that we acquired 3 months ago, that owner was not represented by an M&A advisor. We do recommend that a business owner have high quality legal counsel and their existing trusted relationships from an accounting perspective. The accounting side is important because the due diligence process, as I said earlier, is extremely robust, and we find that many business owners want to lean on their existing accounting service provider to help them in that process. And then when we get into the legal process, obviously the asset purchase agreement, which is the primary document that governs the purchase of the target company, is a complicated legal document where the seller is going to be making representations and warranties to us as the buyer about the business. And so, we have found that the money spent on high-quality legal counsel is typically a good investment for a seller.
Okay, great information. Thank you. All right, next here, looks like we're talking about the financial reporting. If a company already has a history of annual reviews of its financials and annual accounting reviews, do you still want it to have a full audit?
Yeah, so all of our businesses are required to be audited for 2 reasons. Number one, our lenders will require that the business be audited. The debt financing agreements that we have with the lenders will stipulate that the business is audited on an annual basis. And secondarily, Hadley Capital is audited on an annual basis for the benefit of our investors. And so in order for Hadley Capital to be audited, its underlying investments or its underlying companies also need to be audited. And so those 2 requirements are in place and are something that we don't have any ability to influence or change.
Paul, just a follow-up question on that. So is the audit requirement going forward, or is it also going back to the most recent year end?
Good question, John, and I apologize if I wasn't clear on that. So the audit requirement is only on a go-forward basis, and so only NewCo would bear that audit expense. There would be no accounting or audit expense for the prior owners.
Okay, then that kind of ties in with our next question about what fees this guest is asking that he or she can expect as a business owner, during this process, and who pays for them.
Megan, can you ask the question one more time? I'm not sure I got the whole thing.
No problem. Basically, what fees can I, the business owner, expect, and during this process with partnering with private equity, and who pays for them? Okay,
that's a good question. So a business owner will have expenses in the course of a transaction, as will Hadley Capital. And when we enter into a letter of intent, the letter of intent will stipulate that each party pays its own expenses. So the primary expenses that a business owner will face in a transaction are the legal expenses associated with papering the actual transaction. To the extent that a business owner has an M&A advisor, they would also, that they have retained, they would also have to pay that M&A advisor. There may be some some ancillary expenses that are relatively insignificant in the course of a transaction, but those two would be the primary ones. The biggest, I think the biggest cost in any transaction is the time required to get it done. The time of the owner, the time of the owner's management team, et cetera. It's a very time-consuming process. It can be very distracting, and so the decision to enter into a transaction really should be driven more by the goals of an owner and an understanding of the time and commitment that's going to be required to complete a transaction, rather than the hard dollar costs of the transaction. While not insignificant, I think that those things are dwarfed by the time commitment that's required to see a transaction from start to finish. And then Hadley Capital would have expenses on our side from due diligence, legal, et cetera, but we would bear those expenses. Those would not be the seller would not have any responsibility for those expenses.
Okay, and speaking of on time, this guest asks, and also going back to tax implications, he asks that he understands that a seller should plan approximately 18 months before a possible sale transaction, especially tax planning. Could you offer your advice or experience on that, please?
So if we were to look at the transactions that we've completed over the last 10 years, and we've done this, the time from our first introduction to a business owner to a close of a transaction is in excess of 12 months. And so, that can seem like a really long time to a business owner. But what we found is that that's kind of what it takes. We've also had situations where we've been introduced to a business owner and the timing just wasn't right for one reason or another. And so we've had situations where we had a conversation and 2 or 3 years later we'd finally do a transaction. In that interim period there was nothing going on from a transaction point of view, but the timing just wasn't right. And so it can be extremely variable based on what a business owner's needs are. But what we find is that in the transactions that we've done, it's been in excess of 12 months from introduction to closing.
Paul, can you break that down even more specifically? So introduction to closing, how about from introduction to signing LOI and then the second phase LOI to closing? Can you break down those two periods?
Yeah, so the LOI to closing is 3 months roughly, and then so the question is, what's happening in those other prior 9 months? We take entering into a letter of intent very seriously, and maybe this is a little bit of a difference between us and other private equity firms. We're going to do a lot of work before we put a letter of intent in front of a business owner, and so if we were to divide that 9 months into 3 segments, the first 3 months, just between the initial introduction, conversations, getting to know each other better, maybe even having meetings, going to a dinner together, et cetera, that can easily consume a couple of months. And then in that middle period, we're doing a fair amount of work with the business owner to try to ascertain our interest level, our seriousness, our ability to execute on a letter of intent that we're going to put in front of them. They will then subsequently evaluate that letter, talk to their advisors about it, and it's easy. Then in cases there'll be holidays that comes into play, and it's easy for the time to really pass by. In a situation where a business owner is represented by an M&A advisor, and we've certainly sold companies using M&A advisors, our experience is that process. That process takes 9 months, and so I don't think our process is terribly longer than it could be otherwise. But in order to do these things and do them the right way, like I said, it's a significant commitment in time.
Yeah, I agree, and I just wanted to expand on that because I've from my own personal experience, I've seen that a lot of business owners think that the process should go a lot quicker than it does, but there's just so many moving parts and so many things to consider that, an average of 12 months, I think, as you had mentioned, is kind of what I've seen as well. So just wanted to clarify that for the business owners on the call today.
Yeah, and John, one thing that I'll say is when we produce our first due diligence request list for a business owner, what we tell them is look, we're going to be moving faster than you will be, and typically they will roll their eyes at us and say, oh, no, this won't be any problem. And in our experience, we are not the ones slowing the transaction down. In most cases, it's the business's ability to run the business and transaction process, and that's not a criticism at all. Continuing to run the business has to be the business owner's primary objective, and that's more than a full-time job. So then to add to it a transaction process, which in itself could be considered a full-time job, and it is for many M&A advisors, that's a significant workload. And so, I think it's important for business owners to go into it eyes wide open about what the requirements of a transaction process, an M&A transaction process, really are.
Yeah, and I loved your point, around the fees that, everybody thinks about the hard dollar costs of legal fees and transaction costs and everything else, but the biggest one, as you had mentioned, is the time commitment of all this. So, great point and great advice that business owners need to go into this again with eyes wide open to really recognize that, hey, this takes time, and it's a roller coaster ride. But in the end, with great partners like Hadley Capital, you can get through it pretty efficiently and effectively. So just wrapping up here, I see that one of our guests has a number of very specific questions around tax. I don't know that we will address it on this webinar here, but I'll pass along those questions to Paul, and then Paul, if you can maybe reach out to this specific guest and have a conversation with him, I think that would be beneficial for both sides there.
Yeah, and anybody else that has any specific questions, my information is on the last page of the webinar deck. Feel free to reach out. I'd be more than happy to have a conversation about these topics or anything else that may be on your mind.
Yeah, and that's a great reminder for me. Paul has written a series of articles on Divestopedia around the topic of these areas of what changes for a business owner after private equity investment. So we will provide links to those, and you can definitely review those and have those as a reference point for just kind of revisiting some of the issues that Paul has talked about. We also have a recording of the webinar on our site, so you can keep on coming back to this, and I think it's been great advice. So Paul, appreciate you being on this webinar and providing this very specific and detailed information for our guests. Thank you for everyone for attending, and please join us for other future webinars. With that, have a great afternoon.